In the second chapter, we'll look at the most attractive investment opportunities in the fixed income space, and we'll also analyze some of the key challenges. Emerging market debt is one of the favored segments in the fixed income market.
The classical relationship between the Fed and the performance of emerging markets is still there, simply because emerging market investors are mainly coming from the outside and not inside investors, the local investors. But of course, the share of the local investors is increasing rapidly. So whenever the Fed is increasing interest rates and makes local bonds, corporate bonds, sovereign bonds, etc. more attractive, some investors decide to leave the emerging markets that are perceived to have higher political risks, etc., and to invest at home. So I think this is not broken yet, this relationship. In general, we are quite positive on emerging markets. We see, in general, good growth. We have the hope that with the Phase 1 deal between China and the US, economies are stabilizing, especially in Asia, simply because it's good for spreads. If the economy is running quite well, this helps especially corporate bonds and high-yield bonds. And this is what we are likely to see in this year.
But the overall environment is still with ample liquidity, easing more or less, or some sort of easing overall, and that's positive for emerging market debt. And local currency in particular could be one of the exposures which we like. I do more kind of coupon clipping strategies on the hard currency EM debt for this year.
We should not underestimate the strength of the local central bank, because the liquidity also in these companies and the economic state of these countries is really very good. And on the other side, I would be very cautious in regards to local currency, because for private investors it could be a little bit ugly sometimes. So therefore we would favor rather hard currency, but which is interesting is emerging market corporates. And then corporates which have a revenue stream in US dollar. This could be quite interesting to think about. Because those are more or less independent of local currency problems or local political problems. Not completely independent, but more independent.
Emerging market hard debt looks substantially better than US high yield or investment grade, in particular taking into account the debt levels of the US companies. I think that's an issue. And with regard to the local currency bonds, obviously you shouldn't do it in individual countries. You need to do it in a diversified manner. And I think the current environment is actually positive for that. Because in this environment where the Fed is not going to tighten soon, where we are seeing a relief with regard to the trade war, where we are expecting stabilization of growth, that's supportive for emerging market currencies. And indeed, when you look at trade-weighted currency baskets, the dollar has peaked in September, and since then the emerging market currencies trade-weighted have appreciated. So I think currently local currency is attractive.
Companies in the high-yield space are still good quality, or is the quality deteriorating compared to the past? And if the economy starts to slow down, do you see any risk of default rate increasing?
Credit profiles on the broader scale in Europe among European corporates are sound, while there is a very elevated risk of negative developments that if there would be a contraction in the US, probably not a base case for most of us here for 2020, but it could increase 2021, 2022, right? Of course. If that would materialize, there is a risk of a corporate balance sheet crisis in the US because of high debt levels and the dependency in particular also on equity valuations to continue with share buybacks, etc.
That's why I would prefer emerging high-yield corporates, because as you said, in the US, the leverage is very high, and in the emerging countries, it's 20% lower. So given that they are more resilient, they have suffered Brexit, trade wars, etc., etc. On the valuation perspective, it is more attractive. It is more resilient. If US high yield should widen, that would be probably an opportunity because EM high yield corporates are more resilient and to step into that space.
I would see for the entire market, the risk stems from the BBB space, from the fallen angel, because it's very difficult for the high yield market to absorb that. Yeah. But credit profiles have not only deteriorated on the BBB side, they have already also deteriorated on the high yield side. And also valuations, if you look at spread per unit of leverage and whatever, valuations are fairly stretched in US.
So I fully agree on it's attractive, but what we have to know is that a lot of money goes into this direction, and it's heavily investable also with passive products. So I think it's quite a volatile space. But there are attractive buckets in the EM space which may not be passively investable to the same extent, or which have some other added value which are more attractive. So all the inclusion stories, when you think about Chinese bonds, for example, which will be supported for years to come from higher weightings in the major fixed income indices. So even if investor flow dries up a bit with regard to EM, they will be supported by this continued inclusion story. You could even widen the space and say we are not just talking about EM, but we are looking into frontier markets that may benefit once they are upgraded to emerging market status and then included into emerging market indices, and therefore then benefit from these inflows.
The first point is China. Definitely, it's a very long-term story. It's coming to the global ag in March 19, so obviously big indexers like us have been starting to buy around 30 basis points a month of Chinese bonds. But it's gone into the Bloomberg Barclays indices already in March as well, last year, 2019. And today in our portfolios, for example, we've got up to 5% in China. And there it's very diversified. It's more than 150 bonds, treasury bonds from China. So that's a long-term trend. It's improving the quality of the emerging market index overall. It's lowering the yield, indeed, but it is still, higher yield than U.S. Treasuries, definitely more higher yield than bonds. Second point, and it's more about the positioning of large investors. We talk about the domestic investors, local currency, emerging market, treasury bonds are more and more domestic as well. Those countries are they've been growing. There's pension funds, banks, insurance markets, which didn't exist 20 years ago. Institutional investors, the ones that we measure through the bond compass that we publish, so State Street data based on the institutional investors' positioning, they're close to the second percentile of positioning. That means that they've been only underweight emerging markets versus their 5-year average only 2% of the time over the past 5 years. So there is ample room in portfolios from those large investors as well to continue to boost that emerging market allocation. Afterwards, from a private wealth management, but when you take the aggregate private wealth management, it's a very institutional market. There is also room to grow in those portfolios.
I think we all agree that low and stable growth in the US is Goldilocks for emerging markets, in particular dollar-based hard currency stuff. But that means that left and right of that scenario, there is the risk. So, which means that if there is higher growth than we anticipate in the US, that would be dollar positive and kind of prompt the Fed to hike interest rates, so lift the treasury curve. That could be detrimental. We've seen this development. On the other side, if there would be lower growth in the US, even a recession, then demand side would collapse. So the risk is that currently this scenario is Goldilocks for emerging markets, but left and right of that, there is the risk. So there is an element of instability in this strategy, and I think we have to be aware of that.